Welcome to Yahoo Finance's flagship show, Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the government shutdown could be coming to an end. The House of Representatives will vote today whether to end the 43-day-long shutdown. Speaker of the House, Mike Johnson, said he believes the legislation will pass quickly. The longest shutdown in U.S. history has snarled air travel, delayed food aid to millions of Americans, and forced federal workers to go without pay. Stock futures are gaining on the back of that progress. Plus, shares of stablecoin issuer Circle sliding after the company reported third quarter earnings. Investors are concerned that lower interest rates will slow Circle's profit growth. The company earns most of its profit from the interest paid on government securities that it holds in reserve to back its stablecoin. The concerns offset what was otherwise a decent earnings report, even more than decent. Circle posted higher than estimated revenue and earnings in its third quarter. And stick with Yahoo Finance, because tomorrow we are bringing you a full day of market-moving conversations with Wall Street heavyweights and C-suite execs. We'll be covering everything from AI to crypto to the economy. We'll speak to Strategy's Michael Saylor, former Federal Reserve Vice Chair Lael Brainard, Reddit co-founder Alex Ohanian, and a slew of CEOs, including Palantir CEO Alex Karp, who we'll also hear from for that event. Plus, we'll hear from Pfizer CEO Albert Bourla, Delta CEO Ed Bastian, and we'll have many more amazing guests. The event kicks off tomorrow at 8 a.m. Eastern Time. You don't want to miss it. Let's get a check-in on stock futures right now. We are seeing some strength across the board here. Now, is it shutdown? Is it AI back and forth? Who knows? But for whatever reason, we are seeing the Dow show a gain of almost 120 points when it opens up. That's where futures are pointing here this morning. S&P futures pointing to a gain of about 1/3%, and NASDAQ 100 futures pointing to a gain of about 0.6%. So let's dig into our top stories of the day now. The House is set to vote on that funding bill to reopen the government, and on running, raising its full-year guidance after topping third quarter expectations. Plus, Circle beating third quarter estimates, but the stock is being weighed down by concerns about lower interest rates. Joining me now, our Federal Reserve correspondent Jennifer Schonberger, senior reporter Brooke DePalma live at the NASDAQ, and senior markets reporter Ines Ferre. Jennifer, I want to start with you and what's going on in Washington and sort of the tick-tock here of what to expect.
Yeah, Julie, after 43 days, it looks like we are finally going to see the closing act of this shutdown showdown, with the House expected to convene later this afternoon to begin the process on voting to reopen the government. I do expect that vote sometime this evening, hopefully with the government reopening as soon as midnight. Of course, that hinges on when President Trump signs the legislation. The president has said that he does support this and will sign whatever is handed over to him. Again, this expected to pass. All Republicans expected to be on board for this after the Senate was able to squeak this legislation through, with 8 Democrats joining Republicans late on Sunday, breaking with progressives, creating some bad blood within the party. Nevertheless, this will be the first vote that the House has taken since September 19th, when Speaker Johnson held a clean vote on a continuing resolution to keep the government open, and then left, leading to what we saw then as this 43-day shutdown. Now, I also want to know, this may just be the beginning of the road, because this is only going to keep the government open through the end of January. There's still a lot of horse trading that needs to be done. Only the legislative branch, the military, and the Department of Agriculture are going to see a full year funding from the government. And they still need to hash out all the negotiations over those healthcare premiums, which is what started all of this to begin with. Majority Leader in the Senate, John Thune, expected to hold a vote on that sometime in December.
Okay, so there's all of this, and then there's what you typically talk about, which is the Federal Reserve. And obviously this has implications for the Fed and all of us because of data. And so, you know, we're looking for that cadence of data to hopefully to resume quickly. What are we hearing from sort of Fed speakers in the meantime?
Right, exactly, Julie. This shutdown has really stopped the flow of what is known as the gold standard of government data that the Fed uses to make monetary policy. And so we're going to we're not going to see that immediately come as soon as the government reopens. That's going to be a slow trickle. So I think Fed officials are still going to sort of remain in a fog, if you will, over the next, 3 to 4 weeks or so, especially even as we start to get some of the data. We've seen a lot of furloughs over this period, so there's going to be a lot of cloudiness there before we start to see the sun sort of break through. Today, we do have a full deck of Fed speakers, starting this morning with New York Fed President John Williams, who is kicking off the annual Treasury Market Conference at the New York Fed. And then later this afternoon, we're going to hear from Atlanta Fed President Raphael Bostic, as well as Fed Governor Stephen Miron and Susan Collins of the Boston Fed, all of which are going to be giving their outlook for the economy and monetary policy. We haven't yet heard from Susan Collins since the FOMC meeting, so it'll be interesting to hear her perspective, especially as we've seen such a divided Fed going into the December meeting, rather.
And let's talk about the market backdrop, Brooke, for all of this. You know, it feels like the AI, yes, it's dependent on the shutdown, but it also feels like a lot like it's sort of AI on off depending on the day. So what kind of commentary are you seeing out there today?
Julie, what I'm hearing from my sources is that there's this renewed optimism heading into today's trading session on the hope that this government shutdown will end. And on top of that, what we heard from AMD yesterday at their analyst day here at the NASDAQ is lots of momentum around that AI trade. And that's what's really fueling the early innings of this pre-market trading session. What we're seeing this morning, what we heard rather from AMD is that stock moving higher this morning after CEO Lisa Su gave some optimistic outlook about what exactly AI is set to be and the revenue that this company is expecting from it. Lisa Su told investors and analysts yesterday that the data center revenue will jump 60% over the next 3 to 5 years. And that really is leading to some renewed optimism around the AI trade this morning, flowing through the NASDAQ as well. And on top of that, too, others are saying that this could be a broadening rally, that it's not really just these tech sectors, but other areas of this market that could also feel the momentum behind AI as well. And some of my sources I was even speaking to is potential partnerships with Eli Lilly, that company also getting in on this AI trade, and just this AI momentum really seeing the benefit in other sectors as well. And perhaps that's what we're seeing this early trading session this morning.
Well, I want to talk about another momentum story that is somewhat arrested or at least suspended or paused today, and that is Circle, which of course has been soaring mostly since its IPO, although well off the highs, out with its earnings this morning. And yes, the earnings look pretty good, but there's still some concerns about future earnings power.
Yeah, it was a strong quarter. I mean, if you take a look at Circle's top and bottom line, you'll see the total revenue and reserve income increased 66%. You saw adjusted earnings per share coming in at 64 cents. The street had been estimated 20 cents. Now, the company earns reserve income on assets backing their stable coins, and the reserve return rate came in at 4.15% for the third quarter. That's down 96 basis points. So the concern that investors have, or why you're seeing the stock lower in pre-market, is because of that return rate. If the Fed keeps lowering rates, then you're going to see that return rate going lower, and that could weigh on profits. Now, this is not lost on the company because the company has been diversifying into other areas to make money. And in fact, one analyst pointing out that their Circle Payments network that increased sharply. It doesn't contribute meaningfully to revenue, but it is a form of diversification. And also in the earnings call that I just hopped off on, the management highlighted ARC. This is their new blockchain network that they had announced this year. They're saying that they have about 100 companies that are participating in the testing of this network. And they also talked about the possibility of launching a native token on that ARC network as well. So a lot of sort of ways that the company is pursuing into growth in other areas. And by the way, they also talked about their market share for stablecoins, up to 29% now from 28% last quarter. So the street has been concerned and has talked about this issue of the reserve income. But in order to do that, they need to either increase market share increase market share or diversify into other areas in order to fend off the competition that is coming.
Yeah, it's definitely a very interesting ongoing story. And then from the sort of new economy to, what you put on your feet. On Running was also out with its numbers this morning. How did they do, Brooke?
Good morning, Julie. Well, heading into this report, the stock was down more than 30%, and now in pre-market trading, we are seeing a pop of more than 20% after the company yet again beat on both the top and bottom line, surpassing Wall Street's expectations. The company also raised its outlook for 2025, and I had a chance to chat with CEO Martin Hoffman over the phone, and what he had told me was that in the first days of November, the momentum is strong, and this really just speaks to this spot in the market right now that seems to be continuing to do well, and that is the premium market. He went on to say that we are really charting our own way in the vision to become the most premium global sportswear brand. Now, keep in mind, their sneakers run for about $100 or more. They're getting into apparel and accessories, but this company really has been able to navigate through President Trump's tariff, a rocky consumer environment, and yet again prove against this perception that the consumer would pull back even after they raised prices back in July. They're still saying that, especially here in the Americas and also in China, they're really keying into a younger consumer. Here in the U.S., they have the spokesperson. They partnered with Zendaya, and they said that this younger consumer keeps showing up, and their consumer is not pulling back. And that's why you're seeing some momentum in this pre-market trading.
Which is fascinating, given some of the other numbers that we are seeing about sort of weakness in hiring among that cohort. So we'll keep watching those numbers. Thank you so much, Jennifer, Brooke, and Ines. And for more on Circle, you can tune in at 10:15 a.m. Eastern for my conversation with the CFO of the company. That's Jeremy Fox-Geen. You don't want to miss that. We'll be talking more about some of those issues that Ines was highlighting. Coming up next on Morning Brief, though, we'll bring you today's top trending tickers and count you down to the opening bell. Now time for some of today's trending tickers. We are watching Infineon, Chevron, and Eli Lilly. First up, Infineon. The German chipmaker forecasts that revenue will return to growth in the 2026 fiscal year. The company says it sees moderate revenue growth fueled by the global boom in artificial intelligence data centers. Shares rose the most since April on that outlook. Data center demand is helping Infineon weather weak growth prospects in its automotive market, which represents about half of its sales. Next up, we got Chevron. The oil giant chose West Texas as the site of its first project to provide natural gas-fired power to an AI data center. Chevron's in exclusive talks, it says, with the data center's end user, which it didn't name. It's the beginning of a new line of business for the oil giant to capitalize on the boom in artificial intelligence. Chevron made that announcement ahead of its Investor Day, which is happening today. It also plans to keep boosting its oil and gas production through 2030. At the same time, it's going to continue to cut structural costs by up to $4 billion by the end of next year. Those shares little changed ahead of that Investor Day. And finally, Eli Lilly, the pharma giant, is dropping CVS's drug benefit plan for its employees. According to Bloomberg, Lilly made the decision after CVS chose to stop covering its weight loss drug in favor of a rival medication from Novo Nordisk. Lilly will automatically move its employees to a new pharmacy benefit amid that dispute. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, the government shutdown poised to come to an end, but it still left the Fed without key insights into the economy. That could potentially derail hopes for a December cut. And according to the Wall Street Journal, there's a big divide within the Fed. Joining us now, Andrew Szczurowski, Morgan Stanley Senior Fixed Income Portfolio Manager. Andrew, thanks for being here.
Thanks for having me.
So the debate within the Fed, of course, is the labor market more of a risk, or is inflation more of a risk? And right now, we don't have the hard data to back it up. But I know you and your team are tilting more towards labor being that risk. Talk to us about why.
Yeah, look, it's tough for the Fed right now when they're missing on the inflation side of their mandate to be so concerned about the labor market that they have to cut rates more aggressively. But our view is that when you look at the labor market, it's been weakening. Every kind of alternative labor data piece that we've gotten over the last couple months has been trending weaker and weaker. And inflation, it's tough to have sustainable inflation if you have a weakening labor market. This isn't 2022. In 2022, we had 7-8% wage gains. Those companies could pass along those higher prices of goods. Today, we do have tariff inflation that's slowly filtering through. It's going to take a while, but the consumer can't handle it to the same extent they could in 2022. So that's going to be met with demand destruction, which to us means that you can't have sustainable inflation in that environment.
So the labor market weakness will take care of the inflation problem.
Exactly. I think 6-12 months from now, we're not going to be concerned about inflation. And some of the other underlying components of inflation not related to goods. You look at housing, and you've seen home prices starting to decline in certain areas. You've seen rents that are starting to kind of stagnate in certain areas. That makes up the biggest bucket of the CPI index. And to us, that's going to, the services, like kind of deflation that you're starting to see there is going to do some of the lifting for the Fed, where we won't have to be concerned about that 3% inflation anymore.
Well, I guess then the other question is, if you're talking about a labor market that the Fed is paying attention to, is the weakness within the labor market, how much of it is structural? Yeah. How much of it is cyclical? Because we know some of it probably is structural because of AI. Mm-hmm. So when the Fed cuts rates, how much of that will translate into an improving job market?
That's a great question. And some of it's structural because of AI. Some of it's structural because we have kind of a change in immigration policy where you don't need 150,000 jobs a month to keep up with the growing labor force participation. But so to us, that just doing kind of a rate cut here or there might not necessarily cause the kind of payroll gains and companies to start hiring again. I think it's something that we're going to see some of this CapEx spending we've seen over the last couple of years, which it's not very broad based right now. So it's not going to lead to the types of kind of job gains we've seen historically. So I think you could see an environment where you have 2 to 3% GDP growth, but a rising unemployment rate. And so this will be much different than the last couple decades. And so the Fed could be kind of pushing on a string, but there's I think the Fed's going to want to go from a neutral policy to a stimulated policy to try to get some of that breadth included in the kind of payroll market.
So bring it all back to then what you do in the fixed income markets. All of what you're saying seems to imply lower rates, right?
Yeah. So look, if you look at where the market is pricing the end of this Fed hiking cycle, it's a little above 3%. If you went back to where we hiked to the last cycle, we hiked to 2.5%. So to us, neutral is still a little above where it was last cycle, so a little above 2.5%. But that the Fed's going to go through that. And the Fed's going to want, if you want to be stimulative by the end of the cycle, then you're looking at a Fed funds rate that's going to be well inside of 3%, which means if you see a 2-year at 3.55 or a 5-year that's in the kind of similar context, that's worth taking interest rate risk in that environment. We also see it as a free option of sorts at this point. If the Fed's not going to hike anytime soon and the 2-year rate's basically pricing in that the Fed only does essentially one more cut for the next 2 years, to us, that's a great kind of skew to take duration, and so you want to take those risks when you're being compensated for that, and then at some point the market will swing the other too much, and then you'll want to shed some of that duration. But I think you want to be long duration, but in the front to belly of the curve.
And how are you thinking about that as well? I mean, I know you're a fixed income guy, not an equity guy, but with all of these concerns about potential froth in the equity market, even if we're not there yet. Yeah. What does that imply then for how people should be waiting and thinking about their allotment to fixed income right now?
Yeah, I mean, I think the nice thing is that base yields are still pretty high relative to the last 2 decades here in the United States. So that means that you do get paid a real yield again, something above inflation. So while you wait for this kind of whatever happens in the economy to happen, you're being compensated for that. And to us, bonds are a hedge against risk assets again, because inflation is going to moderate. This isn't 2022 where both things went down together. I think that's the important thing and why fixed income can act as that ballast again, is because the Fed is not hiking anytime soon. Inflation, we think, will roll over, and bonds are poised to do well if you have an economic deterioration. Again, we're not saying go way out the risk spectrum, don't go into kind of triple C's, but there's plenty of high quality places you can hide out in the meantime.
Speaking of high quality, or more appropriately low quality, we've been seeing sort of signs of, if there are signs of distress in the economy, usually it shows up in the credit markets in some place or another. I saw this morning auto delinquencies are now ticking up to a record, I think, in data going back to 1994. How important is an indicator like that?
No, I mean, I think everyone knows about the K-shaped recovery that's been going on for years. And so you mentioned kind of subprime auto delinquencies. You're seeing it the same thing on the credit card side. The low FICO consumer has been losing steam and is worse off than they were pre-pandemic. So that's very clear. But it's starting to kind of bleed out the income spectrum, going to the kind of middle class. And I think that's the concerning point, is that this consumer held up so well over the last couple of years coming out of the pandemic, and part of that was they had rising wages, they had a kind of built up of savings, and right now it's the high-end consumer that's doing well. You see kind of record stock prices, record asset appreciation. They're great, but it's the low-end consumer that is slowly bleeding out. And we think that that's something that's going to continue to kind of weigh on certain corporate earnings. And that's something that, again, the Fed prior to the pandemic had this third mandate they were starting to look at, which was kind of income inequality. And I think that's something that's rings even more true today.
If the low income consumer, if that distress starts to spread up the income spectrum, where would you start to see that?
Yeah, look, I think you're going to see it in things like hotel spending and in travel. Some of the things that are those kind of discretionary spending that boomed coming out of the pandemic, that's the first thing to kind of go. You kind of cut back on that vacation. You cut back on your kind of traveling. And so those things you're going to see it first. And I think that right now, if you look on the luxury end, those hotels are still doing well. But I think you're starting to see it at the lower end.
Right. Andrew, thanks for coming in.
Thanks for having me.
Appreciate it. Well, coming up on Yahoo Finance is Opening Bid with our executive editor, Brian Sozzi. He's here now. Soz, what do you got going on today?
We're staying on all things AI. The trade still looks shaky. Julie, really love your chat there as well. I think it highlights some of the things we're going to get into on the jobs market front. And then full-on invest hype and preparation. Stock of the day is Pfizer. Ahead of our chat with Dr. Albert Bourla, Pfizer CEO, tomorrow.
I'm looking forward to that. All right, that does it for Morning Brief. Much more ahead on Yahoo Finance, including Opening Bid.